You're listening to Capital Topics, episode number 58. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, since we're approaching the year-end of 2023, we'll discuss year-end tax planning strategies for individual investors. And for our next topic, we chat with Raymond Kerzerho, PWL Senior Researcher, about his latest blog regarding Canada's major pension plans. Enjoy! Good morning, James. How are you today?
I'm fine, François. How are you?
I'm good, thank you. Well, it's that time of the year again to cover year-end tax planning strategies for investors in capital market securities. It has been an annual tradition for us on the podcast. We want to remind our listeners that the insights and advice we'll be sharing will be general in nature. We would need more detailed understanding of an investor's tax and financial situation to give specific recommendation. Listeners should consult their tax advisors, portfolio managers, and financial planners for personalized recommendations.
Yes, François, and I also want to remind our listeners that when we talk about tax planning, we adopt the optimizing mindset, which is a very different concept than minimizing your taxes at all costs. By optimize, we mean you need to think not just about the current tax year, but how your assets will evolve over the longer term and how you will need to plan your current and/or future retirement income withdrawal needs so they're tax effective. I've often highlighted that investors should consider that they are building assets in three separate buckets. Registered accounts like RSPs and later RIFs are all pre-tax money, so look at that as the bucket on the left. On the right-hand side, you'll have, for entrepreneurs, holding companies where they accumulate investment capital dividends from their operating companies. And that's also pre-tax money. So that's the bucket on the right-hand side. Mm-hmm. And in the middle, you have your personal taxable accounts and your tax-free savings account. So I like to say you pay for groceries out of that middle bucket.
Yeah, as a reminder to our listeners, like you just mentioned, James, ideally you want to pay your groceries with the middle bucket. We often have retirees prospect that come to us and they have no funds accumulated in the middle bucket. Or even worse, they arrive at 71, 72 with all their assets in multi-million-dollar RSPs or RIFs and no money in the other two buckets.
That's really a great point, François. So where should we start year-end tax planning chat today? I will break it down to four big topics. First off is for all investors, how to trade smartly to optimize your taxable capital gains or losses. Secondly, what are the actions investors need to take before year-end December 31st, 2023? Thirdly, we'll review the new contribution limits for RSPs in 2023 and the tax-free savings account. And we're also going to cover the new first home savings account. Finally, we'll go over major changes that are coming into effect in 2024 concerning alternative minimum tax rules.
Mm-hmm. The first planning topic is about how to trade smartly to optimize taxable capital gains or losses in your taxable account. You'll need to know your 2023 history of capital gains and losses for that. Start with getting the realized capital gains and losses report for the year-to-date 2023 for your personal taxable account. For your holding companies, the realized capital gains and losses report should be based obviously on the company's fiscal year end.
For our clients, François, who have been with us many years, as you well know, they've benefited from the deferral power of passive strategies in their taxable accounts, and that, we would optimize the realization of capital gains on the equity side of the portfolios primarily. But I remind our listeners that investment decisions must take precedence over tax considerations.
Yes, James, I totally agree here. This means getting back to the engineering of your portfolio. It's always important to make sure that your current asset allocation is in line with your long-term target asset allocation. The main reason for rebalancing is to bring your portfolio back to its long-term target asset allocation. In a rising stock market, if you don't rebalance your portfolio, you'll always end up with a higher percentage of your portfolios in equities, therefore with a riskier, more volatile portfolio. It's always better to rebalance your portfolio regularly to take profits off the table instead of waiting for a market sell-off to do it for you.
So, François, where does the rebalancing process start?
Well, I would advise our listeners to consider 4 things before trading in their portfolios. Beware of the superficial loss rule. 1, can you carry back losses realized in 2023 to the 3 prior years? Don't forget, there's also a currency impact on sale of security held in foreign currency. And you must be mindful of the last trading day for settlement in 2023, which this year is December 27th.
I think we should add, François, that the tax rule is any losses you have not used in the current year can be carried back 3 years or carried forward indefinitely. So to be able to use a loss in the current year, as you said, the trade must settle prior to year end. So that this year, the last day is December 27th. So it settles by December 31st. Remember to avoid the loss being considered superficial. It's important that you or an affiliated individual, as defined in a tax code, don't repurchase an identical position 30 days before or after the sale.
Yeah, correct. And you should always start your rebalancing process in a registered account because selling a position that have gain will not have any tax consequences. By contrast, rebalancing your taxable account may trigger a capital gain and taxes payable. For investors that need to make their annual RIF withdrawal before year end, you can take the opportunity of rebalancing to raise the cash for your withdrawal.
Investors also, François, need to be on the lookout for ETF and mutual fund year-end capital gains distributions. Normally, these occur in December. These distributions are the result of fund managers selling some of their holdings during the year. And if you hold your ETF or mutual fund in a taxable account, you may have to pay taxes on these distributions.
Correct. The thing here with year-end capital distribution is that contrary to monthly or quarterly distribution that are paid in cash, the capital gains distribution in December are paid as a reinvested distribution, so no cash is distributed to you. For an investor who holds the position in a non-registered account or taxable account, taxes will need to be paid even if you haven't received any cash.
So again, with passively managed ETFs and mutual funds, you don't usually see a large distributions at year end of capital gains, but it's always a good idea to look at your ETF or mutual fund provider's website in November because they provide estimates of what the annual capital gains are going to be like.
Yeah, correct. In some cases, if the fund is distributing a large capital gain, it could make sense also to sell it and avoid the distribution. But before you go ahead and sell your position, make sure you are not triggering an even larger capital gain on your transaction. Also, if you are implementing a portfolio close to year end, you may want to wait for the ex-dividend date before buying into a fund that will make a large capital gains distribution. So, James, now let's talk about planning ideas regarding the registered accounts, RSPs, TFSAs, RESPs, and the newly FHSA.
Okay, so let's start with the RRSPs. The current year maximum RSP contribution room is $30,780, and it's based on the earned income of last year, 2022. Listeners can find their RSP room on their 2022 Federal Notice of Assessment. This number will include unused contribution room carried forward from prior years. The 2024 maximum RSP contribution will be a little higher at $31,560. And that's for those listeners who like to make early bird contributions at the beginning of the year. For business owners, consider declaring T4 salary of at least $175,333 by December 31st, 2023. This will, in effect, create the maximum RSP contribution of $31,560 that I just mentioned for 2024. And if you've turned 71 in 2023, don't forget you must convert your RSP to a RIF. Otherwise, tax consequences are very negative, and you have until December 31st to do so. That said, don't forget to make any final contributions to your RSP before converting it if you have the room.
Yeah, that's a great point, James. What do you have to share now for TFSAs?
Well, for TFSAs, there are a lot of planning points. First off, the TFSA dollar limit is $6,500 for 2023, but there's no deadline for making a TFSA contribution. Unused contribution room is just carried forward. The CRA has also announced the limit for 2024, and it has also gone up to $7,000.
Nice,
and again,
nice.
It is nice. Best to make your contribution as early as possible in the new year to benefit from that tax-free compounding. For listeners who have not maximized their TFSA since 2009, they should check online with the CRA website to confirm their contribution room. If you've never done a contribution, the maximum room since 2009 cumulative is $88,000 in 2023. That said, be careful, however, if you've withdrawn funds from your TFSA in 2023, you must wait for 2024 to recontribute the amount withdrawn. If you are planning a TFSA withdrawal in early 2024, we suggest you consider withdrawing the funds before December 31st. There are no tax consequences, but this way you'll be able to recontribute them if you have the money sometime in 2024. You won't have to wait till 2025.
Right. Next up, it's the new First Home Savings Account, FHSA. We covered this topic in our podcast number 52, published earlier this year. Now, James, what do you have to say?
Well, again, we still have to get used to the acronym FHSA. There's a lot of planning points, François. First off, you must verify if you qualify to open a First Home Savings Account. You can visit CRA's online website to make sure you meet the requirements. It really is for first-time home buyers, but it also allows people who haven't owned a home, who owned one before 4 years ago, to open one. So again, check to see if you qualify. In 2023, the contribution cannot exceed $8,000. That is the first year the plan is available. You can claim a tax deduction for contributions within this limit in 2023 or in a future year if not claimed previously. Unlike RSPs, contributions you make within the first 60 days of 2024 cannot be deducted in 2023. And finally, what I'd have to say about FHSAs is the rules are complicated, and as this plan is new and we are still discovering new details as we addressed each individual situation. So please consult your advisor on how to best optimize this.
Correct. Now, let's look at our ESPs. We also covered this topic in a recent podcast, number 56. James?
Well, as our listeners who know from that podcast, our ESPs are really also very complicated. Again, for those making contributions for their children, to get the maximum Canada Education Savings Grant, it's $2,500 of current year contribution. And if you didn't contribute the maximum in prior years, you have $2,500 of catch up. So that's a total of a $5,000 limit to get the cap for an individual year on contributions. If you have less than 7 years before your beneficiary child turns 17 and haven't maximized RSP contributions, really try hard to make that contribution before December 31st of this year, because otherwise you're not going to reach the ultimate total maximum of $7,200 in federal government grants. And you don't want to miss out on 20% of free money on your contributions. Yeah. Secondly, the federal government this year has increased the maximum education assistance payments, or EAPs, that can be taken in the first 13 weeks of post-secondary education, and that they've increased it to $8,000 from $5,000 previously for full-time students, and increased it to $4,000 from $2,500 for part-time students. If your child is a beneficiary and stopped attending a post-secondary educational institution in 2023, EAPs can only be paid out for up to 6 months after the student has left school. Just as importantly, about cashing out the final amounts for the child who's completed their studies, you want to maybe consider taking all the EAP out in 2023, because next year could be their full year of employment income, and they may end up paying tax that's higher than if they withdraw it all this year. So that's what I'd have to say about RESPs.
All right. Now, for our next point, the federal government has made changes to the Alternative Minimum Tax, AMT, that will start in 2024. James, could you briefly summarize how AMT works?
Yeah, well, François, first off, Alternative Minimum Tax, AMT, affects very few taxpayers, but the new rules really are going to apply to taxpayers who generate more than $173,000 of personal taxable income. The changes will significantly impact, in our view, high-income earners who make large charitable donations particularly. The alternative minimum tax system imposes a minimum level of tax on taxpayers who claim certain tax deductions, exemptions, or credits to reduce the tax that they owe to a very low level. Under the AMT system, there is a parallel tax calculation that allows fewer deductions, exemptions, and credits than under the regular income tax calculation. If the amount of tax calculated under the AMT system is more than the amount of tax owing under the regular tax system, then that difference owing is the AMT payable for the year.
Mm-hmm. So, James, what are the changes for 2024?
Well, the big changes is that the alternative minimum tax rate increases to 20%, and the exemption is increased to, as I mentioned earlier, $173,000 of taxable income. They've also broadened the base on which AMT is calculated by limiting certain exemptions, deductions, and credits that reduces taxes.
What should taxpayers do, James, before December 31st?
So again, for many high-income earners, gifting publicly traded securities with accrued capital gains, what we call in-kind contributions to a registered charity or a foundation, is a favorite year-end tax planning strategy. And given these new AMT rules, high-income earning taxpayers who plan large donations in 2024 should really consider making those donations this year.
This year-end tax planning strategy is attractive as you get a tax receipt for the fair market value of the security being donated.
Well, yeah, that's really the magic, François. So I would add one of the key tax benefits of gifting publicly traded securities with large accrued gains in kind is that it also eliminates the capital gains tax.
Yeah, we do this for many clients. Taxpayers should plan gifting in kind well before year end to allow for sufficient time to execute this type of donation. James, it would be helpful for listeners to know the new AMT rules and how it impacts large donations.
Well, okay, so if a taxpayer plans to make significant charitable donations, there are two significant changes as a result of the new AMT rules. As of 2024, only 50% of the donation tax credit would be allowed when calculating AMT, compared to 100% currently allowed. Secondly, if you make in-kind donations of publicly listed securities, 30% of the capital gain on those securities will be included when calculating AMT. Currently, none of the gain is included.
Yeah, we recommend that our listener consult their tax advisors well before year end to determine strategies that may help to reduce their exposure to AMT. Are there any other tax moves that you recommend taking before year end, James?
Yeah, again, focusing on investors and capital markets. Number one, pay your investment expenses to claim a tax deduction or credit in 2023. This includes interest paid on money borrowed for investing and investment counseling fees incurred for managing non-registered accounts. Secondly, for our retiree listeners, the dreaded old age security clawback is always a big concern. You need to make sure that your income does not exceed the recovery thresholds. So let's share with our listeners the current numbers. So taxpayers must repay their old age security at a rate of 15% of their 2023 net income in excess of $86,912. So the threshold's gone up by about $5,000 versus last year. The entire old age security amount must be repaid if a taxpayer has net income in excess of $142,609 for taxpayers between ages 65 to 74, or if a taxpayer has net income in excess of $148,179 and is age 75 or up. This is a means test that also amounts to a form of double taxation in many people's mind. And because old age security is an individual benefit, it is not impacted by family income, but instead is clawed back based on individual taxable income.
What about tax installment for 2023? What's your advice for listeners?
Well, the advice is always the same. Have you made enough quarterly tax installments? The final tax installments are due on quarterly December 15th. Now that you have a pretty good idea of your total income for 2023, you can decide if you actually need to make that final payment. Again, you may have had much higher income in the prior year, so this year you may owe less. However, a word of caution, if you haven't made the amounts requested and you end up owing significant tax on April 30th, you may be subject to penalty interest for unpaid amounts. It's always safer to pay the amount requested unless there are major changes to your 23 income versus the prior year.
Yeah, another point that our listeners need to take note of is that interest income will be much higher in 2023 compared to 2022. Even though you make all your tax installments in 2023 as requested, you may still end up owing a lot more taxes comes next April 30th.
Finally, François, we've said many times in our podcast, tax planning should be done all year long. Do not wait for year end to optimize your taxes.
Yeah, indeed, James, and I hope they do. I believe we have covered a lot of ground here, and hopefully our listeners will find this update very useful. I also want to remind our listeners that our comments and advice on this podcast are generic in nature, and all our listeners should consult their tax and financial advisors. Now for our next topic, we'll welcome Raymond Kerzerho, who's PWL Senior Researcher, and we will discuss his latest blog regarding Canada's major pension plans. Good morning, Ray. We are pleased to have you back on the podcast.
Morning, François. I'm glad to be back.
Ray, you are here today to discuss your latest blog post that was recently published on the PWL Capital's website entitled 12 Observations about the Big Canadian Pension Managers and 8 Takeaways for Individual Investors. Over the years at PWL, you have often published internal research paper on this topic. Now that you have shared this latest blog with the public, can you tell us why reviewing these large pension funds manager has been a worthwhile exercise for our clients and what our listeners should take away?
Sure. The Big 9 Canadian pension managers are at the leading edge of investment management. Although they don't disclose everything they do, their annual reports provide a lot of insight. I think anyone who has interest in money management should look at what they do and ask themselves, is there something in what they do that would make sense for my portfolio? Some things do and some others don't. That's the whole point of this post.
Yes, Ray, I can definitely say that I agree. And again, welcome back to our podcast. The research you have done for us over the years on large Canadian pension funds has really been very useful. And it's helped us as portfolio managers in our thinking and how to improve the engineering of our clients' portfolios. So our large Canadian pension plans are really, truly world-class organizations. I'm not sure all Canadians realize this. As you have quoted, Ray, in your introduction, the World Bank in their 2017 paper about the Canadian pension fund model has said, and I quote, "Canada is home to some of the world's most admired and successful public pension organizations." I think that as a Canadian and a future retiree, we can all be very proud that our political leaders had the foresight of creating these funds and leaving them independent.
Yeah, I totally agree with what you just said, James. Now, coming back to Ray's blog, Ray, you make 12 observations about large pension managers in your blog. You call them the Big 9. Can you tell us or tell our audience what the Big 9 means?
Sure. The Big 9, they're the 9 largest Canadian public pension managers. They are responsible for assets totaling $2.1 trillion. This is an amount similar to the combined assets of the mutual fund and ETF industries in Canada combined.
So Ray, I'm guessing that within that group of 9, you'll find the CPP Investment Board that manages the Canada Pension Plan and also the Caisse de dépôt et placement du Québec. So Ray, within your 12 observations, which one are the most relevant for our audience?
There are 3 things I'd like to discuss here. First, the Big 9 are incredibly successful. A paper published in 2021 by a group of researchers found that Canadian pension funds literally trounced their global peers. The Big 9 annual reports confirm that. They all beat their benchmark over 10 years. That's outstanding.
Yeah, that's quite a big achievement. But apart from having a lot of success and beating their benchmark, what else did you observe?
Yeah, sure. A couple more things. The second thing that struck me was these managers have transformed these portfolios in the last decade or so. During the 2010s, the world went through a period of extremely low bond yields. In response to that environment, most of these managers have drastically reduced their bond allocations in favor of riskier alternatives, such as private debt, private real estate, and infrastructure. And lastly, some of these organizations can be quite expensive to run. Collectively, they have cost $15 billion last year. Costs may run from 0.44% or 44 basis points if you prefer, to almost 1% of their assets. But the most expensive managers are not necessarily the best. In fact, the manager that outperformed the most over 10 years is also the cheapest. There's a saying that if you pay peanuts, you'll get monkeys. But it's not what I see with the big nine. Low costs and great results can go together.
And that's a very interesting material and observations you share with us, Ray. I mean, $15 billion, that's a lot of money to spend, but a lot of it's internal, but there's a lot of it's for external managers as well. And it's exactly in line with our thinking that lower fees increases the chance of long-term investment success. Now, from your observations, can you share with our listeners the key takeaways for them that they could apply in their portfolios as retail investors?
Yeah. Well, the big nine, they do a few things that investors should emulate for sure. They diversify globally, and they keep cash allocations to a minimum. These are things that everyone can do competently and efficiently with low-cost ETFs. Another thing I noticed is they don't have big allocations to hedge funds, and they avoid crypto. I agree with that, and I wouldn't touch any of these products.
Right, those are things that you would copy. Are there things that you would not copy from the big nine?
Oh, yes, absolutely. I wouldn't copy from the big nine things such as replacing bonds with private real estate and infrastructure. These big managers invest a lot in private assets, and they have the professional staff to do all the required complex due diligence and manage these assets at costs that, frankly, very few can match.
Ray, do you have examples of how the big nines reduce these costs of private investments for our audience?
Sure. The big nine use several cost reduction strategies. For example, they co-invest with private equity firms. That's very technical. To illustrate what I mean, what they do is they go to private equity firms and say, okay, we'll invest in your funds and we'll pay you fees for that. But you will also allow us to invest directly in portfolio companies. However, on these direct participations, we won't pay any fees.
Right. What we see more and more is private investment funds directly marketed to retail investors. What do you think about that?
Investors should beware. The costs are brutal. My advice really is don't do that with your portfolio. The high fees are going to enrich the fund managers at your expense. Stick with broadly diversified low-cost stock and bond ETFs, and you'll likely get better long-term results.
Ray, I've noticed in your blog that the returns generated by these big nine pension fund managers have been significantly better than what has been available in public capital markets for stocks and bonds. Can you highlight the reasons why?
Yeah, of course. There's many reasons. First, like I said earlier, the big nine outperform almost everyone else, and this includes retail investors. Secondly, returns depend on how you value assets. Between a third and a half of big nine portfolio is invested in private assets. These private assets don't trade publicly, so you need to hire outside experts to value them. Regular stock and bond portfolios are valued daily by the markets. The markets and experts often come to very different conclusions. I'll give you an example. Last year, the S&P Global Real Estate Index returned minus 19%. That's the return according to the stock market. At the same time, the Big Nine's global real estate holdings returned on average plus 5%. Two different valuation methodologies resulted in very different returns.
Drastic difference here.
I'm not saying the experts are wrong. I'm just saying that if both portfolios were valued with the same methodologies, the returns would be likely much closer.
Yeah. In financial jargon, we say one is mark to market, which means that it's priced by the markets daily versus the other that is not mark to market. And also, I think it's fair to say that these large allocations are illiquid investment and that they should generate higher returns.
I agree, François. Now, the third and last factor I'd like to mention here is the big nine can handle a lot more risk than individuals. Think about it. As individuals, we have a limited lifespan and we invest only for our own account. The big pension managers pool the money of millions of Canadians and they are going to be there like forever. Of course, they can handle a lot more risk. They take more risk and they get higher returns.
Well, again, that just makes total sense, right? Risks, I should say plural, and returns are related. Therefore, if you are taking more risk, you should be compensated with higher returns. Thank you very much, Ray, for joining us today. It's always wonderful listening to your latest thoughts.
Thanks for having me.
Yes, thank you, Ray. We hope we'll have you back on our podcast soon. In the meantime, I invite our listeners to consult your blog on the PWL Capital website, and we will add a link to your blog with this podcast. Thank you, James, for sharing your thoughts and expertise with us today.
My pleasure, François.
So that's it for episode number 58 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning, and please join us for our next episode to be released on January 18th next year. In the meantime, make sure you consult the Capital Topics website for our latest blog posts. See you soon.